Hello everyone. Welcome to Mortgages and More presentation by Anil, your friendly neighborhood mortgage agent, and the go-to person for all your mortgage needs. We are going to cover the basics of mortgages today. This presentation will cover the following topics. The definition of high-ratio mortgages. Discuss mortgage default insurance, also known as CMHC insurance. Talk about the new to Canada programs offered by lenders. And, finally, address some of the frequently asked questions. So, let's get started. To understand high-ratio mortgages, we need to first understand the definition of loan-to-value, LTV. The loan-to-value ratio is a financial term used by lenders to assess the lending risk. It is the mortgage amount divided by the property's appraised value, expressed as a percentage. For a mortgage of $400,000, on a property valued at $500,000, the LTV is calculated as $400,000 divided by $500,000, which is 80%. The higher the ratio, the higher the risk for the lenders. Mortgages with a loan-to-value ratio of 80% or lower are referred to as conventional mortgages. That means the buyer has to put a down payment of 20% or more. These mortgages pose a moderate risk to the lenders, as the buyers have a minimum of 20% equity in the property. On the other hand, the mortgages where the buyer puts less than 20% down payment are referred to as high-ratio mortgages. Here the loan-to-value is greater than 80% and can go up to a maximum of 95%. Given the higher risk associated, these mortgages typically require a mortgage default insurance.
Thanks Ed for that introduction. Hey guys, this is Anil, your friendly neighborhood mortgage agent. I'll continue the presentation from here. So as we have seen earlier, the high ratio mortgages with less than 20% down payment would need a mortgage default insurance, colloquially known as the CMHC insurance. We have three insurers that provide us with the mortgage default insurance: CMHC, the erstwhile Genworth, which is now known as Sagen, and Canada Guarantee. Until June 2020, all three had very similar underwriting criteria, but starting July 2020, CMHC has tightened the rules a little, so we are seeing a trend where more business is going towards the other two insurers. The high ratio mortgages need an insurance, and then the insurers have certain criteria to be met. Let's see what they are. Firstly, the loan to value has to be less than or equal to 95%. What that means is we need to have 5% down payment. The 5% down technically applies to the first $500,000 of the purchase price. In case the property value is over $500,000, we need to have 10% down payment for the amount greater than $500,000. For example, for a $700,000 property, we need 5% of $500,000, which is $25,000, and 10% of the next $200,000, which is $20,000. So we are looking at a total down payment of $45,000 for a $700,000 property. The second condition is that the property value should not exceed $1 million. What that means is, for high ratio mortgages, if you're putting less than 20% down, the maximum property value should be under $1 million. For any property values over $1 million, you need to have a minimum of 20% down payment for a conventional mortgage. The third criteria is that the maximum amortization allowed is 25 years. So typically some people opt for 30 years to keep the debt low. That means lower monthly payments. You can't do that if you are having a high ratio insured mortgage. And people ask, are there any advantages of taking the mortgage default insurance and putting less than 20% down payment? I think there are some advantages. One is, if you're going to take longer time to accumulate the 20% down payment, the mortgage default insurance allows you to opt for a high ratio mortgage where you put less than 20% down. In a way, you're able to build your equity sooner because you're buying the property sooner than later and starting to build equity, your monthly payments are going towards your home purchase versus a rental property. And you would have noticed there's a lot of ads that give you low rates, but they all say for high ratio mortgages. So typically, because the mortgage is insured, the lenders are able to give better rates because the risk is carried by the insurer, right? If the mortgage defaults, the lenders get paid by the insurer, so they do tend to give better rates for the high ratio mortgages. So here we have a table which gives you the premium amount. So if you're doing absolute low down payment, that's somewhere between 5 and 10%, your premium is 4% of the mortgage amount. Likewise, if you're between 85 to 90%, your premium is 3.1%. So there is a little benefit. You get reduced premium if you're increasing your down payment. So typically you see a big jump from 4 to 3.1 if you can stretch your down payment to 10%. So this is something to consider. And there are ways to increase your down payment. You could withdraw your RRSP funds if you are a first-time home buyer. So keep that in mind. Or some lenders do accept gifted equity coming from your siblings or parents. So there are ways you could try and reduce the premium amount if you wish to do so. How soon can I get a mortgage if I'm new to Canada? Sooner than you think. This has become my favorite topic, so to say. There is a lot of misinformation being spread about mortgage eligibility for the new immigrants. We have all heard many baseless stories of people saying, hey, you need 35% down payment if you're new here, or you need to wait for 2 years and build a great credit score before you can apply for a mortgage, and so on. Most lenders and all insurers have new to Canada programs for mortgages, and you could qualify for a mortgage in as little as 3 to 4 months after moving to Canada if certain criteria are met. Firstly, you need to have a stable job with a provable income. Now, what does that mean? If you are in a salaried position with an annual pay, not hourly pay, but an annual pay, the only requirement here is that you need to be out of probation, which is typically 3 months. In this scenario, one could secure a mortgage by providing the employment letter and 2 recent pay stubs. However, if you are on an hourly pay and the hours are not guaranteed, or if you have a commission-based pay, we need the last 2 years T4 so that we can take the average income. So in this case, the wait is a little longer and you need to wait for at least 2 years before you can apply for a mortgage. The other important requirement is to have a decent credit history. So my advice to all the new immigrants is to open a credit card account as soon as possible so that you start building your credit history by making timely payments every month. It's recommended to have at least 2 trades for 3 to 4 months before we apply for a mortgage so that we demonstrate your payment history. 2 trades could either be 2 credit cards or a combination of 1 credit card and a car loan or a phone line. So please do opt for credit cards which are easy to get approved so that we avoid multiple credit checks which could negatively impact your score. It is important to keep the credit card utilization under 30% and pay off your bills every month, as this could help build your credit history. People ask if it's okay to have a car loan or a car lease prior to applying for a mortgage. The answer is both yes and no. It is good to have a car loan or lease as it helps build good credit history, but then we need to remember that any large monthly payments could lower your mortgage eligibility. As a ballpark, if your car payments and the other monthly debt payments together are under 5% of your gross monthly income of the household, it should typically be okay and it wouldn't come in the way of your mortgage eligibility. So the key is to keep all your non-mortgage monthly payments under 5% of your monthly gross income. Feel free to reach out to me or your mortgage advisor to discuss your specific scenarios. The other aspect is PR versus work permit. What kind of differences do we see? Typically, from a mortgage perspective, it doesn't matter much. However, if you are on a work permit, please do talk to your tax accountant to know how the non-resident speculative tax of 15% could impact you. Frequently asked questions. Let's answer some of these. What is a mortgage pre-approval? It's a conditional approval provided by a lender based on the information you have provided. It helps to know your mortgage eligibility as a dollar value, say $560,000. This way you can focus on the right properties within your budget. And if you're wondering what could change between pre-approval and the final approval, it is the property valuation. At the pre-approval stage, the property details are not available. So it's important to understand that if you have purchased a property way above the market value, the lenders will always fund a percentage of the appraised value and not the purchase value. For a conventional mortgage, the maximum loan to value is 80% of the appraised value, regardless of what you have agreed to pay in the sale agreement. So this is something you need to remember. Is it okay to change my job after a pre-approval and a few months prior to closing? Short answer is no, but this could vary case by case. Pre-approval was conditional based on your continued employment with a particular employer. Like discussed before, you should be out of probation at the time of closing, so it's not a great idea to change jobs if you're planning to buy a house in the near term. After pre-approval, if you happen to change your job, it's always safer to discuss with your mortgage agent on the next steps. How long does pre-approval and approval take? Well, it depends on the lenders. There are lenders who can do a pre-approval in 2 days and an approval in 3 to 4 days, and some could take as long as 2 to 3 weeks. So talk to your mortgage agent on the available options. If you have any further questions, feel free to drop me an email, text me, or leave a comment on my Facebook page. I will get back to you as soon as I can. Thanks so much for attending this presentation.